Good morning all. Today we are going to discuss about cash flow statement. In accounting for decision making subject, the third unit you have cash flow statement. Cash flow statement, it means that the movement of cash from your business organization. That means inflow and outflow of cash. Inflow and outflow of cash. So it will, the inflow and the outflow of the cash, it will happen with various activities of the business like operating activities, investing activities and financing activities. So by these kind of activities, various source of funds will get into your business and various source of funds will goes out from your business. So what is the impact on the balance sheet? From the balance sheet, how can you identify the cash flow, that is movement of cash? That will be identified with the help of cash flow statement. So here in this session you are going to learn about what is cash flow statement and what are the activities which involve in that cash flow statement, and the examples, various examples of cash flow statement, cash inflows and outflows, and how it will be impact and how it will be reflect in that preparation of cash flow statement, and differences between fund flow statement and cash flow statement. Funds flow statement you know very well, we will discuss later. Then the format, various different formats for preparation of cash flow statement. So we are going to see that. Please stay online. Statement of changes in financial position. So statement of changes in financial position, with the help of cash flow statement you can identify. So the cash flow statement, it provides information about various cash inflows like various cash receipt, and it provides information about cash outflows by various uses of cash during a period of time. So the inflows and outflows are reported for operating activities and investing activities and financing activities. So the cash flow statement, it provides variable information about the cash receipt and cash payments for a particular time period. For example, between 2 years. For example, 2 years, 2 balance sheets. You can take it as 2 balance sheets. So the inflows and outflows are reported for operating activities. Operating activities, it means that the business operation which involve in day-to-day operations. Then investing activities. So investing activities, it related to the investment made by the company. And financing activity. Financing activity, it means that the source of fund raised by the way of issuing shares or debentures or getting long-term loan, etc., etc. So you have 3 activities, that is operating activity and investing activity and financing activity. So with the help of these 3 activities, the cash inflow and outflow will be happen. Cash inflow and outflow will be happen. So let us discuss one by one. The operating activities, investing activities, financing activities. You have 3 type of activities for inflow and outflow of cash. For inflow and outflow of cash. For operating activities, when cash receipt exceed cash expenditure, it means inflow of cash. So the arrow mark will make you to understand. So when cash receipt, that means revenue exceed expenditure, it means that inflow of cash. And second one is investing activity. Investing activity, with the help of examples you may be understood what is investing activities. Sale of property, sale of plant and machinery, sale of equipment, and sale of debt and equity securities, and collection of loan from other entities. Suppose in your company you may be issue loans to others, third parties. If you collect loan from the third parties, that will comes under inflow of cash. There is an inflow. With the help of investing activity, you will have in your business organization have some investing, some inflows. And financing activity, issuance of equity securities and issue of debt. So by the way of issuing share capital, your company is raised finance. And issue of debt, it means bonds and debentures and commercial papers and various promissory notes, etc. So this three activities will provide cash into your business, inflow of cash, inflow of cash. The same activities which have some outflow. So operating activities, you have some inflow, and the same thing, you have some outflows. So operating activities, when cash expenditure exceed cash receipt. When cash expenditure exceed cash receipt. Okay, it means that outflow of cash. Your receipt is less than the expenses. Then investing activities. So you know, investing, by the way of investing activity, the inflow of cash, sale of property. For investing activity, the outflow of cash, purchase of property. If you purchase a building, you need to spend money. The amount goes out from your organization. So purchase of debt and equity securities of other entities. Suppose your company is ABC Limited. You are going to purchase debentures of XYZ Limited. It means that the cash outflows. The cash outflows. So loan to other entities. Loan to other entities. It means that your organization issue loan to others. Then again, outflow of cash, financing activity, the payment of dividend and redemption of debt, reacquisition of capital, stock, etc. So I hope you understood with the help of this chart what are the inflows are there and what are the outflows are there in an organization. So with the help of operating activity and investing activity and financing activity, the business organization will have some inflows and outflows. So let us see one by one the classification of business activity, inflow and outflow of cash. Operating activity, cash inflow and cash outflow. You have two headings, cash inflow and cash outflow. So the first one is cash inflow. So the cash sales received from debtor, commission and fees, royalty received. So these kind of things will bring cash into your business organization. So these kind of things will bring cash into your business. And if you go for cash outflows, cash purchases and payment to creditors and cash operating expenses and payment of wages and income tax, manufacturing expenses. So these kind of operating things, operating items will reduce your cash balance. Okay, so with the help of operating activities, you may some incoming and you may some outgoing of cash, inflow and outflow of cash. So cash affect the transaction on net income. Yes, the cash is affect the transaction on the net income. Let's see the second one, investing activity. So with the help of investing activity, the cash inflow, the sale of fixed assets and sale of investment, interest received, dividend received, working capital recovery. So these things, from these kind of activities, the company's cash balance will increase. The company's cash box will filled with cash by the way of doing this kind of investing activities. Sale of fixed assets. Suppose you have land and building, you sold that into someone else, third party, with some profit added. So your business organization, the amount will increase, the amount will get. That is inflow. Suppose you are purchasing land and building. So your organization is going to purchase land and building. So that things you need to spend amount. Okay, if you sell of fixed assets, your money will incoming, and purchase of fixed assets, the money will outgo. The cash is outflow. The next one is classification of business activities, inflow and outflow of cash by the way of financing activity. So cash inflow, financing activity, financing to the business. So cash inflow, issue of shares in cash, issue of shares in cash, and issue of debenture in cash, issue of debenture in cash, and proceeding from long-term borrowings, proceeding from long-term borrowings. So by the way of issue of preference shares and equity shares to the public, the company will generate money. By the way of issuing debentures, the company will earn money. And also proceed from long-term borrowings. Suppose you are going to apply for a bank loan. If you receive money from bank loan, that will be comes under what? That will be comes under cash inflow through financing activity. And cash outflow, payment of loan. Yes, absolutely. If you are getting loan from bank, that is inflow. If you are paid, that is repayment of loan to the bank is outflow, cash outflow. And payment of dividend and interest paid, repayment of finance and lease liabilities. So these things are cash inflows and outflows with the help of financing activity. So let us discuss the objectives of cash flow statement. Objectives of cash flow statement. So the first point is cash flow statement, it highlighting the cash flow from different activities. Yes, it highlighting the cash flow. The movement of cash is highlighted with the help of cash flow statement. And short-term planning. With the help of cash flow statement, the company can take a short-term decision and short-term plan for effective cash management. And cash flow information helps to understand the liquidity. So what is your liquidity position? Liquidity, it means that the cash is, the assets which is easily converted into cash, that is liquidity. The liquidity position of the company, it can be understood. I hope you all understood some basic concept about cash flow statement. Let us start with problems and solution. We are going to discuss one based on two balance sheet, how to prepare cash flow statement, and how to identify the cash from operations, etc., etc. We are going to discuss now. Please stay online. So let us start with cash flow statement with practical problems and also with suitable solution. So here you have one problem. You need to identify the cash flow statement, cash from operation of the company. Let us start with that question. The following are the balance sheet and income statement of Om Limited. You have list of liabilities and assets for the two period, that is 1/1/2006 and 31st December 2006. So liabilities, share capital 1,80,000 during opening balance, 1/1/2006, the share capital is 1,80,000, and 31st December 2006, 2,22,000, and profit and loss account, creditors, outstanding expenses, provision for tax, and provision for depreciation building you have, and under asset side you have land, building and current assets, you have cash, debtors, stock, advances. You have two different values, that is opening balance and closing balance. That the thing which is given in that 1/1/2006 is called as opening balance, and 31/12/2006 is called as closing balance. So information, you have one information that company sold building during the year, cost price of which was rupees 36,000. So the company during the year, the cost price of 36,000 which is sold out. Okay, right. Now you have current assets and current liabilities, and as well as you have fixed assets and fixed liabilities. Based on this information, you have to do some workings to find out the needed information. Okay, let us start with that. You have one additional information, that is profit and loss account for the year ended. In that question you have two balance sheet and profit and loss account is there. That is trading and profit and loss account is there. That is cost of sales 9,90,000 and wages, salaries 1,20,000 and gross profit 1,50,000. That 1,50,000 will be transferred to the credit side, and you have net sales of 2,60,000, and operating expenses you have 40,000 and depreciation 30,000, provision for tax 44,000 and net profit 42,000. Buy balance brought down 75,900, that will be transferred, that is provision for taxation from the profit and loss account. The balance, opening balance will be transferred here, and the closing balance will be 81,900, which is transferred from balance sheet. So with this information, you need to go ahead with, you are required to prepare cash flow statement. You are required to prepare cash flow statement. So let us start with the solution. For that, you need to prepare some adjustments, that is provision for tax account. Provision for tax is a liability. From that balance sheet, you have to take the value, that is buy balance brought down 6,000, that is closing balance of provision for tax, and to balance carry down, that is 6,600 is opening balance of provision for tax. Then what is the profit and loss account provision? The provision is 44,000, which is taken from the profit and loss account. Now the balancing figure is 43,400. The balancing figure is 43,400. It means that cash outflow 43,400 rupees you have paid for tax. So with the help of preparing provision for tax account, you can identify the payment of tax 43,400, which is cash outflow. Okay. The second adjustment is building account. So opening balance of building is an asset. So opening balance of building will be debit side, 1,80,000 is debit side. And closing balance of building 2,88,000. So all things will be available in that balance sheet. Then depreciation provision, by depreciation provision 24,000, and profit and loss account, profit on sale of building 6,000, the sale 18,000, by bank account sale 18,000, the balancing figure 1,44,000 will be purchase. Okay, 3,30,000. And the next adjustment is depreciation for provision on building account. So opening balance of liability, that is provision for depreciation, will be comes under credit side. So buy balance brought down 60,000 and to balance carried down 66,000, and to building account 24,000 depreciation, and current year depreciation 30,000. So balancing figure 24,000 will be the current, depreciation for building. Then adjusted profit and loss account. You need to prepare based on the above workings, adjusted profit and loss account. So for that, opening balance of profit and loss account will be credit, the debit side, and closing balance 75,900, and provision for tax 44,000, which is given from the workings, and provision for depreciation building 30,000, which is taken from the workings, and dividend paid 36,000, which is taken from the profit and loss account, and you have adjusted profit 1,10,000 rupees. So from all the above workings, you will get the provision for tax is first workings, and buildings account second workings, and depreciation provision on building is third workings. From this workings, you will get the 1,10,000 rupees adjusted profit. See, now all the adjustments, workings are over. Now let us start with that cash flow statement. Okay, so cash flow statement of Home Limited for the year ending 31st March 2016 as per Accounting Standard 3. Yes, cash flow statement will deals with Accounting Standard 3. Now you can start with that, the order of presentation. The first one is cash flow from operating activities. Cash flow from operating activities. So profit before tax. Profit before tax is 1,10,000, which is taken from the adjusted profit and loss account. Adjusted profit and loss account. And add or less changes in working capital. Add or less changes in working capital. So now you just compare depreciation, debtors from opening balance to closing balance. Increase. If debtors is increase, that is cash outflow. Okay, debtors is increase means negative balance, the cash is not yet collected so far. So increase in debtors, so outflow of the cash that will be given in that bracket. Then increase in advances 600, again it is cash outflow. Then decrease in stock 84,000. It impact that the value will be sold out, so positive. An increase in outstanding expenses 12,000. Increase in outstanding expenses 12,000. So now you can find out the cash flow from operating activities. You just add all those things, positive value, just add 1,10,000 plus 84,000 plus 12,000, you will get one value. From that value, just subtract 9,000 and 600 and 3,000. So 1,10,000, I repeat, 1,10,000 plus 84,000 plus 12,000 minus 9,000 minus 600 minus 3,000, you will get 1,93,400. 1,93,400 cash flow from operating activities. Cash flow from operating activities. Less tax paid 43,400. Less tax paid 43,400. Now net cash flow from operating activity, that is total A. Net cash flow from operating activity total A, that is 1,50,000. So 1,93,400 is cash flow from operating activity minus tax paid, you will get 43,400, you will get 1,50,000. That 1,50,000 consider as net cash flow from operating activities. Okay, then cash flow from investing activity. Cash flow from investing activity. So purchase of land, you just refer question paper asset side, purchase of land. So opening balance and closing balance in excess decreasing 24,000. So I mean the purchase of land, it means that cash outgoing. Cash is outgoing. So cash flow is outgoing. So if it is outgoing, you have to given in that bracket, you have to subtract from the total. And purchase of building, refer building account. We have workings, building workings, no? From that you have to refer that building. 1,44,000 you will get. Then after that, sale of building, again you have to refer the building workings account. 18,000 will be a positive one. And now you just add this cash flow from investing activity, that is 24,000 plus 144, 1,44,000. You will get 1,68,000 minus 18,000. If you add that 18,000, you will get 1,15,000 negative balance, 1,15,000 cash outflow. So with the help of cash from operating activities, 1,50,000 is inflow. With the help of with the transaction of investing activities, you will get the 1,50,000 as outflow. So now we go for third one. Cash flow from financing activities. Issue equity shares 42,000 and dividend paid 36,000. Issue of equity shares 42,000 and dividend paid 36,000. You will get one value, that is 6,000 rupees. Net cash flow from financing activity, 42,000 positive value and 36,000 negative value, you will get 6,000 rupees. So from 1,50,000 cash flow from operating activities 1,50,000 and cash flow from financing activity 1,50,000, that will be 0. Then finally you have cash flow from financing activity 6,000 rupees. Now the 6,000 rupees will be the A plus B plus C, that is operating activities plus investing activities plus financing activities. Add opening balance of cash 30,000, you will get the closing balance of cash. Add opening balance of cash, you will get the closing balance of cash, that is 6,000. See, the cash flow statement answer will be available in that balance sheet itself. See, opening balance of cash is 30,000 and closing balance of cash is 36,000. You have to justify how 30 has become 36,000. In what way? How the inflows and outflows are there. Okay, I hope you get my point. You have to do some workings. To identify the tax paid, you have to prepare provision for tax account. And you have to identify the value of building purchase 1,44,000. For that you need to prepare building account. Okay. Then you need to prepare depreciation, provision for depreciation on building account to identify the current year depreciation. And you need to prepare adjusted profit and loss account in order to find out the what? Adjusted profit and loss account, adjusted profit 1,10,000. From that adjusted profit, you can go with statement of preparation. You have to add, cash flow from operating activities, profit before tax 1,10,000. Add changes in working capital. If it is current assets increase, you just given in bracket, that will be subtracted from the total. If current assets decrease, you just give without bracket, that is added value, positive value. If you do like this, you will get the 1,50,000 after tax payment, net cash flow from operating activity. Then you just compare with balance sheet and refer adjustment. You will get investing activity, purchase of land, that will be cash outflow, and purchase of building, cash outflow, and sale of building, again it is sale of building is inflow of the cash. So you will get the 1,50,000, 1,44,000 plus 24, 1,68,000 minus 18,000, you have to 1,50,000. And cash flow from financing activity 42,000, and dividend paid 36,000. And finally you will get the net cash flow from all activities A plus B plus C, that is 6,000, and add opening balance 30,000 and closing balance you will get 36,000. I hope you understood the concept. I hope you all understood about basics of cash flow statement, as well as with the help of that problem and solution, I hope you able to know how to prepare the cash flow statement and how to do some workings on that. So thank you very much.